Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Brian Johnson from Trader Edge. Before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. Again, this is for educational purposes only. So with that, I'm going to stop sharing and welcome you, Brian, to the roundtable. It's your first time, so we're really glad you could make it and looking forward to your presentation. So you should be able to go ahead and share. There you go.
All right. Do you see the screen?
I do.
All right. Great.
So again, yep. Thanks again for coming.
Let me just get the chat panel down so I can see it before I get started. All right, Tom. Well, I actually appreciate the opportunity to present to the group. I've actually followed your group for some time, as you know, so it's a great opportunity for me to be able to provide some information to the group relative to some of the research that I've done. We've got a lot of material to cover today, and specifically some of it's a little bit more complex with respect to hedging. So I don't want to spend a lot of time on some of the preliminary information, but I did want to provide just a little bit of overview of my background. So I'm an investment professional with over 30 years of experience. I started as a fixed income portfolio manager in the 1980s. I was hired by a private investment management firm to start the fixed income index business, which we grew to about $13 billion over the time that I was there. And when I left, the firm actually had about $59 billion under management in both stocks and bonds. I'm currently a full-time proprietary trader, trading primarily options, futures, ETFs, and some stocks, although rarely stocks. And I've developed for my own use over 30 different algorithmic or rule-based strategies. The reason I talk about my trading background is because there's really one takeaway that I've come across in my years of trading. And the one thing that I devote the vast majority of my research and efforts to is developing and exploiting new practical analytical frameworks and tools. And the reason I do that is it adds an extra level of discipline and structure and also efficiency to my portfolio management and investment process. That work involves modeling, so understanding different variable relationships, identifying overvalued and undervalued securities, unique ways to measure risk, or actually combining valuation and risk concepts together, portfolio construction, forecasting, and then obviously optimization. Optimization can be either portfolio optimization or back testing, a lot of which I've used the new Monte Carlo software to do a lot of my option back testing, which is relevant to this presentation as well. So in addition to my professional background from a trading perspective, I was also a former adjunct professor, so I spent 7 years teaching and developing derivatives classes, both at the undergraduate level at Elon University in North Carolina, and I also taught in the MBA level at UNCG as well, all of which involved derivatives classes. So I taught some other finance classes for Elon, but eventually I developed a derivatives class, which was primarily related to teaching futures and options. A few years ago, I formed TraderEdge.net, did a lot of writing for Trader Edge initially, but over time, the demands of trading full-time, and also I began writing a few years ago as well. I've written 4 books in the last 4 years, and every time I write one, I swear I'm never going to do it again, and I think I'm serious this time, but we'll see. My first book, Option Strategy, Risk-Return Ratios. Next one, Exploiting Earnings Volatility. But the one we're really going to talk about today is the one that just came out actually a short time ago, Option Strategy, Hedging, and Risk Management. That book, very similar to many of my publications, includes a spreadsheet that accompanies the book that's available for free for the download. And there's definitely a relationship between the books that I write and my research. The book ideas come out of tools and resources that I found that I needed in my own personal portfolio management and that I'm looking for to enhance my own investment process. And if I believe those are applicable to other investors, then when possible, I try to write that up either on Trader Edge or in the form of a book or an article. Now, the most recent I actually call an article. It's 120 pages, the Option Strategy, Hedging, and Risk Management book, so I may either refer to it as an article or a book, but it's actually, as I said before, 120 pages. Before I get into the detail of the presentation, I would encourage questions throughout, and I wanted to give you an overview of what we're going to talk about. So obviously, if the question is on topic, then that's the perfect time to ask. If it's something that's going to come up later, then possibly it's better to wait until we get to that point. So I just want to talk about briefly why we trade option income strategies. I know this group is a very sophisticated and experienced group with respect to options, but I don't feel comfortable talking about a presentation without at least mentioning the edge or why we actually do those trades. Same thing with respect to position sizing. Again, most experienced traders are familiar with the position sizing calculation, but the spreadsheet that accompanies the book has a section on position sizing, so I just wanted to show you that and show you how it would actually be used. In that particular case, I'm just going to use a screenshot to show you the position sizing calculations from the spreadsheet because it's easier to read. Once we get through that, we'll go into the bulk of the presentation. So we'll talk about two different types of hedging techniques. The first one is hedging using index futures, what I call the free hedge. And for that, we're going to do a specific hedging example using an actual option income strategy, an iron condor, and we're going to evaluate and hedge the downside exit. So futures can be used to hedge exits. They can actually also be used to hedge adjustments if you prefer to do that as well. And finally, I'll take you through the actual futures hedge calculation using the actual iron condor trade. So in addition to futures, what we'll find out is that futures alone are not sufficient from a hedging perspective. I know you guys are familiar with hedging, but I'm going to show you the techniques that I use and the analytical framework behind it for hedging using VIX call options. Hedging with VIX call options are much more complicated than hedging with standard put options on the underlying securities, or TINIs, as many of you refer them to. So for example, to understand VIX call options, we need to look at the VIX index itself. So we need to be able to model the VIX index. We need to be able to understand the term structure of the VIX, in other words, the futures term structure of the VIX. We need to actually construct a VIX futures model to understand how those prices will change in response to changes in the VIX index. And then once we have all of that information, then we can actually use that collectively to construct the VIX call hedge. As I mentioned before, it is actually a complicated process. So the benefit of the work that I've done is that the spreadsheet is an interactive spreadsheet that basically for you. So that's the VIX call hedge. Once we're through the VIX call hedge, if we have any time remaining, I'll talk briefly about using the underlying put options on the SPX, and hopefully at a minimum, I'll at least be able to show you the results from those hedges as well. And then finally, just a brief resource summary at the end of the presentation. All right, so briefly, with respect to option income strategies, why do we trade option income strategies? We trade option income strategies because, at least on the equity indices, the options themselves are chronically overvalued. The easiest way to see that is that when implied volatility is greater than realized volatility, and when I talk about realized volatility, I'm talking about the volatility that we actually experience while owning the iron condor or option income strategy. If the implied volatility is greater than realized volatility, then we benefit from selling overvalued options. One of the easiest ways to see this is to look at the option view, which actually provides this information in one of their tables. And it calculates the difference between implied volatility and what they actually call statistical volatility. And they do that over a number of different time periods. So I pulled up the SPX as of April 17th, 2000. And for the 3-week period, 6 weeks, 10 weeks, 1.5 years, 3 years, and so forth, every single one of those periods, the implied volatility exceeded the statistical volatility. So that's encouraging, and it indicates that on average, depending on how those positions were managed, if we sold or created an option income strategy and sold chronically overvalued options during that time period, we would have generated excess returns. Now, many traders do not realize that not all options are chronically overvalued. The equity indices definitely are, but I find it very useful to use this feature in option view to identify whether the underlying securities themselves and the options on those underlying securities are in fact or have in fact been chronically overvalued over their history. One area that is definitely not investigated by many traders, mainly because the backtesting capability is very difficult to come by and use, is that not all option income strategy environments are created equal. So what I've done in one of my recent publications called Option Income Strategy Trade Filters, I'm not going to spend a lot of time on this, but I just want to give you a flavor for how using filters can actually add value in general. In that article, I looked at 15,000 iron condor trades in the RUT, SPX, and the NDX, entered on a daily basis from 2004 through 2016. With no filter whatsoever, the profit factor of those trades, which is the cumulative gains divided by the absolute value of the cumulative losses, the profit factor was 2.10, meaning we experienced $2 in gains for every $1 of losses over all of those transactions. 85% winners and an average return on required capital of 3.2%, 3.22%. So that's no filter whatsoever. In the book, I also introduced 10 different types of filters, one of which was proprietary, but 10 different types of filters and ran 100 different back tests and aggregated the results. So simply by using a filter based on the IV skew, we increased the profit factor from 210 to 322, IV rank up to 291, RSI up to 281. Using the VIX term structure itself, we increased the profit factor up to 394. You can see the corresponding percentage of winners, 89, 88, 88, and so forth. Question is, what is the average ROC annualized? It's basically, I haven't annualized the number, but it's 3.22% per trade. So if you're looking at a trade with an average time period of approximately a month, then basically it's 12 times that amount. And return on, yes, ROC is return on capital, return on required capital specifically. What is the formula for OIS rank? Okay, the OIS. So one of the filters in the book is a proprietary filter. The other 9 are actually standard filters like the IV skew, IV rank, RSI, and so forth. But one of them is proprietary. That's the OIS UF filter, which is the option income strategy universal filter, which is available via subscription. It calculates uses a proprietary algorithm to calculate a numerical rank, and that numerical rank is associated with different performance over that 12-year time period. So simply using a filter of 40, meaning when the universal filter exceeded 40, the profit factor increased to 515, percentage of winners up to 92, and the average return on capital up to 553. Similarly, if we were to combine that with the RSI filter itself, we can come up with an astronomical profit filter factor of 26, 98% winners, and average return on capital. However, very few trades would actually meet the combined criteria. I just wanted to give you a flavor for that. Tom suggested offering a discount to that subscription, which I'll talk about at the end of the presentation, but I will offer a discount for that subscription, a 10% discount. So instead of the normal $59 a month, it's $53 a month, and that will expire approximately 1 month from today. All right, so enough of that. Let's actually get into the meat of the presentation. Question in the chat panel from Chris. The filter raised the trade expectancy but dramatically reduced the number of trades. Total return is much lower. That's absolutely correct. So it's really a question of whether you want to reduce your number of trades and have a much higher return on capital, lower your drawdowns, or whether you prefer to trade more often, which will definitely increase your total portfolio return. Because as I mentioned before, you still have a positive return expectancy of 3.22% for every trade, even with no filter. So if you're going to limit your trades to an OIS above 40 or use the VIX term structure, it will definitely reduce your number of trades, but it's really just a question of personal preference. The underlyings that I was trading was the RUT, SPX, and the NDX, again, from that 12-year time period. Okay, so position sizing. Again, most of you are probably familiar with this, but again, I do include this information in the book, so I wanted to actually include it here as well. Rather than go through use the spreadsheet for this purpose, I think it'll be a lot easier to use this slide because the screenshot is much bigger here and should be easier to read. So briefly, the review of the position sizing formula. The position size represents the percentage of our overall capital that we're going to invest in an individual security. You can use Reg T if you want to use it for that purposes, or the maximum loss on the position. So we're trying to calculate the maximum amount that we should allocate to an individual trade or to a group of trades. To do that, we need to enter our maximum total capital at risk, so our desired maximum total capital at risk. In this example, I'm just assuming that we're going to be risking 5% of our total capital. We'll lose 5% of our total capital if we incur the maximum loss on the trade. In this case, I'm assuming the maximum loss is 10%. What that means is that we plan to exit the trade or group of trades once we incur or hit that trigger level of a 10% loss. If we incur a 10% loss, then we would want to ensure that it does not exceed 5% of our total capital at risk. To do that, we divide the 5% by the 10% maximum loss, and it gives us a 50% that we could actually allocate to the position, which means, again, using the spreadsheet is set up in such a way that all of the blue cells are input cells, and all of the other cells are actually calculation cells. So we enter a dollar amount just to make it easy to see the impact on your overall portfolio. Enter the desired return on capital, total capital at risk of 5%. Enter the maximum loss on the trade in terms of where we plan to exit the trade, and the spreadsheet will calculate the maximum position size of 50% of our total capital. So on a $1 million account, that would represent $500,000 in capital allocated to the position. All right, so the top part of that spreadsheet calculates the position size, but the bottom part of the spreadsheet can be used as a form of what-if analysis. So in this case, I'm going to assume that we use the same 50% that we calculated above here as our actual position size. So it says we can allocate 50% of our portfolio to the position. We do allocate 50% of the portfolio to the position, but instead of incurring a 10% loss, we actually incur 100% loss on the trade due to a black swan event. In the case of the black swan event, because we could not exit the position when we wanted to, we did not incur a 10% loss on the trade. We actually incurred a 100% loss on the trade. As a result, we lose 50% of our position instead of 5%. Takeaway is we must ensure that we can actually exit at the planned maximum loss, which in this case, which was just a hypothetical example, is 10%. So to do that, we need hedging techniques. So let's move on to the bulk of the presentation. We'll talk about futures hedging next. Okay, so we're going to talk about hedging with indexed futures. To do that, I'm going to use a specific example. The specific example is I'm going to assume that we have an iron condor position, but it doesn't matter what type of position we have. It could be any type of option income strategy. It could be any of the many flavors of butterflies, Kevlar trades, road trip trades. It really doesn't matter. The point is that we need to be able to calculate and hedge ourselves at the maximum loss level on the trade. So I'm going to assume that we're going to limit the maximum loss on the iron condor trade to 20% of the required capital. And I'm going to assume that we have a required capital for this position of $107,000, and we're going to use futures to hedge that transaction. Okay, to do that, we're going to be able to need to figure out where that exit is actually going to occur, because I've actually specified that the maximum loss level would be 20%. So this is a figure from the book, actually, that shows that is taken from OptionView, and it is a simple iron condor strategy in OptionView that has a required capital position of $106,000. And it is constructed using a delta rule. So the delta rule is our short call is at positive 0.11 on a delta per share basis. The long call is at positive 0.08. Short put is at negative 0.11, and the long put is at negative 0.08. As I mentioned on the previous page, I'm assuming that we're going to exit the trade, which is one of the trade rules for the strategy, at a maximum loss of 20%. So again, on a $106,000 position, the maximum loss of 20% would be shown by that dark horizontal line at minus roughly $21,000. That line intersects the T plus 0 line at this level. So at 2257.90, which is approximately a 4.7% decline relative to the initial price of the SPX, the T plus 0 line would actually cross the trigger point, and at least according to the option view calculations, we would anticipate that's the trigger level that would generate a $21,000 loss or a 20% loss of the position. That would mean normally if the options market were open at the time, we would want to actually exit that strategy when the price of the SPX reached 2257.90 and we incurred a 20% loss on the trade. However, the option market may or may not be open at that point in time, or we actually just may want more time to work ourselves out of the position. As a result, we're going to use futures, an order on futures, to be able to immediately hedge that position. And when I say hedge, what I mean is we're going to hedge the delta, the position delta, of the position at the point where the price of the SPX drops to 2257. So that number right there, which I recognize is small on your screen, although you may want to use the full screen capability for the rest of this presentation, the position delta of the iron condor, the specific iron condor that we're using in this example, was a positive 372.3, and that occurs at the profit and loss level of minus $20,000. So we're going to need to use that 372.3 to be able to hedge the position. Let me clear that and then move to the next page. So this is the calculation. This is the actual calculation that we would use to determine the number of futures contracts to hedge. This is actually built into the spreadsheet. I think I only have, this is my only formula that's actually in this presentation, but I think you would find it useful to actually see how the calculation is done as well. So in this case, to determine the number of contracts that we're going to be able to need to buy or sell to hedge our position, we take the position delta from option view or from any similar analytical tool that is able to analyze, could be the Thinkorswim platform, it could be anything that we can get a position delta from. So we take the position delta at the exit point, multiply it by -1 because we're going to need to take the opposite side of the trade in futures. We're going to multiply that by the price of the underlying, which in this case is the SPX, divide it by the futures price, which is the price of the E-mini S&P 500 futures contract, and then divide that quantity by 50. So in our actual example, we take the position delta of a positive 372.3, multiply it by -1, multiply it by the price of the SPX, divide it by the price of the E-mini S&P 500 futures contract, divide it by the multiplier, which is 50. That tells us that we would need to sell roughly 7.5 contracts, which is rounded to 7. Obviously, we need to sell an integer number of contracts. So the actual order is a stop limit order to sell 7 E-mini S&P 500 futures contracts with a trigger price of 2258. The trigger price, again, is the point at which we would actually cross that 20% loss threshold. Let me clear that, and I'll go back one page and I'll show you that again. So the trigger point, again, is the 2258, which corresponds to our 20% loss level that we showed you on the previous page. All right, so that's the calculation. And the spreadsheet is also very simple to use. I'm not going to go to the actual spreadsheet unless someone wants to see how it actually works. But again, the one common theme in the spreadsheet is that all of the user input cells are in blue. The only thing that we need to do is enter the position delta for the option strategy at the exit point, which is 372.3. I specify whether it's an index or an ETF, but that has nothing to do with the calculation. We enter in the price of the SPX, which is the price of the underlying, 2366.40. enter in the price of the E-mini S&P 500, which is 2365, and then the futures multiplier, and the spreadsheet actually automatically calculates that the hedge transaction requires us to sell 7 E-mini S&P 500 contracts at the trigger level. Now what at the bottom is it shows that we still have an unhedged position. So because we're selling an integer number of contracts here, we are still left over with a leftover position delta, meaning the hedged position is not completely hedged. We still have some exposure to delta even after executing the E-mini S&P 500 futures order. Got a question here, so let me take a look. I see delta actually decreases further than that, so the -7 ES contracts will not absolutely correct. And that's actually what I was getting to on my next slide, so that helps a lot. So we'll lead right into that. So let's look at the next slide. And the next slide shows that, get my annotation. So the next slide shows that we started with a delta of 372.30. Hedge position is -349, leaves us with a unhedged position of a positive delta of 2250. So what we see here is I'm going to have a scenario where the S&P goes down 10% total immediately overnight. We're fortunate enough to be able to execute the hedge transaction at 2258, but it goes down another 5% roughly after that point in time. So what happens is the Iron Condor loses 85% on that trade. The E-mini S&P 500 goes up by 45,000. So we gain 45,000 due to the hedge. The hedged position in aggregate loses 40 grand, which is 38.1%, and the unhedged position would have lost 80%. So we did much better than the hedged position, than the unhedged position, but the fact is we still lost 38% of our portfolio. And the reason is, which it was actually mentioned in the chat panel, that we could actually enter additional contracts or additional orders to sell additional contracts at prices that are lower down on the below the initial trigger price. And let's just go back briefly, and I'll show you that on the diagram. Let's get rid of those. Go back. Again, it's difficult to see here, but what we see here is the initial delta, and I'll read it off just in case you can't see it on your screen. The initial delta at the trigger point, which is roughly down 5%, was 372.30. The delta at 2237 jumps to 443.40, and then it jumps to 504.30. So we're not even close to down 10% yet, and we see that the initial position delta started at 372, and then actually went all the way up to 504.30. So what we could do is I'll actually bring up the spreadsheet briefly here, and remember that 504.30 that occurred at down 6.4%. So the 504.30, if I get out of that, bring up the spreadsheet on the futures hedge, and enter 504.30. What that shows is that the number of contracts at that level would be -10. So what we could actually do is use option view or something similar to option view to calculate position deltas at prices even below the initial trigger point, which is the initial exit, allowing us, in effect, to dynamically hedge that position. So that is definitely conceivable. We can use the same spreadsheet to do that, and in many cases it would actually be advisable because we are, in fact, hedging. Let me put that back up. We are actually hedging delta, but we're not hedging gamma. So the gamma here is still minus 354, and it remains minus, obviously, as prices continue to decline. So the fact is, we have hedged the position delta, but we've only hedged it instantaneously at a given point. We have not hedged the gamma for further declines. But again, we can use the same spreadsheet tool. Let me clear that. The same spreadsheet tool to just enter position deltas for prices that decline further than our exit point if we want to maintain that hedge for other catastrophic risk events, again, provided the futures market is actually open. All right, so the futures hedging is relatively straightforward. We've seen that it does not work by itself to hedge gamma, although we could use a form of dynamic hedging to do that. But the other issue is, what if the futures market was closed at the time? The good news is the futures market is actually closed for it's open for roughly 23 hours per day, but there is a window on the weekend. And if a catastrophic event actually occurs during that time period, or a very, very large gap were to occur, or new information enters the marketplace, we would be unable to hedge if the futures market was closed. So as a result, futures are definitely useful. It's a zero-cost hedge if that trade is never executed, but it does not fully protect us against black swan events, which, as all of you know, can be catastrophic for virtually all option income strategies. Got a question in the chat panel before we can move on. Brian, I brought your book, Having a Tough Time to Figure Out Which Strike to Insert in the Spreadsheet. So please elaborate on that. Remind me if I don't get to that, but as I go through the example, I hope to use the actual spreadsheet if you guys can actually see it. And to do that, I'll actually explain more about the strike selection at that point. But yes, it is an interesting point in terms of which strikes you actually use. All right, we've talked about hedging with futures, which is the easy part. Now we're actually going to talk about hedging with options. And we're going to start with the most complicated topic, which is hedging with VIX call options. So to do that, I'm going to have to lay a little bit of a foundation with respect to the VIX itself. But once I've done that, you'll be able to see the framework and the analytical framework and the spreadsheet tools, how they apply to VIX calls, which will also be how they apply to S&P put options as well. So the hedge objective, just to keep this in your mind as we go through, is that we need to calculate the number of VIX calls that we would need to purchase among a number of different candidates. And then among those candidates, what we're interested in is calculating the lowest dollar cost per trading day. So we're trying to find the candidate that actually has the lowest cost per trading day. And in addition to that, we'll also be able to analyze our hedge solutions across a number of different candidates and across a number of different scenarios as well. So that's really our objective. So keep that in mind as we go through the process. All of you are probably familiar with the VIX index, but at the same time, it is useful once we start talking about hedging, and we also talk about extreme environments, to understand where the VIX has been in the past. So going back to 2008, if we look at percentile rank, the VIX reached a level of 80.86. So that represents the maximum VIX index value from 1990 through March 2017. The median index value for the VIX was about 1776, and the minimum was about 930. So if we actually have a VIX value, let's say the VIX today was 12%, which obviously it isn't, but if the VIX were 12% today, that would be in the 10th percentile. So knowing this percentile ranking gives us an idea as to where the VIX is at any given point in time and where the market would actually expect it to be in the future. That's the reason to look at the spectrum or the percentile rank or the distribution of VIX index prices over the entire time period the VIX has actually been calculated. All right, so this page is very important. If we're going to understand the VIX index and we're going to actually create hedges using VIX calls, we need to understand VIX futures. That may seem strange because if we're going to invest using VIX call options, why do we need to understand the VIX futures market? And the reason is that VIX call options are priced from the VIX futures market. In other words, the VIX futures price levels in the future, VIX at 0 months represents the index itself. 1 month would represent the 1 month VIX futures contract, or 1 month in the first month's VIX futures contract. 2 represents the second month, and so forth. As we move out into the future, we have a real-time estimate of where the market expects the VIX index to trade 1 month forward, 2 months forward, 3 months forward, and so forth. So the one takeaway that we see from this chart, and what I've done here is I've actually created actual VIX futures data, pricing data, from 4 different dates. So the first one is 11/21/13, which represents a period of complacency or normalcy in the market. And what you see in that environment is an upward sloping VIX curve. So the VIX index itself at the time was 1266, and it slopes upward all the way up to 1893 for the 7-month VIX contract. The reason it slopes upward is mean reversion. Volatility is assumed by the marketplace to revert to the mean. So let me go back to the previous page briefly. If it's going to revert to the mean, and this is the median but not the mean, but the median value is 1776. So if we start out with a VIX index of 2414, then over time the market expects that VIX index to increase up to something closer to the mean or median value over time. So that's the way VIX futures are generally priced. So going back to our example, in this case, the VIX index was 1266 in a relatively complacent environment. We had a positive slope. Jan of 2016 was an interesting environment in that at the time, the market was not sure whether we were in fact going back into a recession or in fact whether the expansion would continue. So what we see is an almost completely level term structure. So at the time, the market participants did not know what was going to happen to the VIX going forward. So that's an example of a term structure, VIX term structure with a level shape. Then let's look at October 3rd of 2008. What we see there is a downward sloping curve. So again, at that point in time, the VIX index would have been at very high elevated level relative to history, and over time the market expected the VIX index to revert something closer to the mean. Now, 10/17/2008 is truly a panic type situation. At the time, the VIX was 67.65, which I'd actually have to go back and look at it, but was in the top couple percentile, if you will, at the time. Not surprisingly, the market expected at that point in time the VIX index to go back down lower as well. So it expected to decrease over time. So even though volatility, both realized volatility, statistical volatility, implied volatility, was extremely high on 10/17/2008, that is not a sustainable situation, and the market anticipated that eventually volatility would actually decline, and that's the way they priced VIX futures. Okay, so the slope equals mean reversion, or said differently, mean reversion explains the slope of the VIX term structure, VIX futures term structure at any given point in time. But there's another takeaway here that's even more important, and that is relative volatility. The relative volatility of the VIX index itself, going from the maximum to the minimum, just for an example, ranged from 1266 all the way up to 66, 67, 65. The 1 month contract, the volatility was reduced. The 2 month contract, it was reduced further. Same thing for 3 months, same thing for 4 months, all the way until we get out to 7 months. And we see that the range for 7 months is dramatically narrower than the range for the VIX index itself. Once again, this is a function of mean reversion. So this information allows us to actually construct a model, a risk model, if you will, for the VIX futures index, which also can be used from a forecasting perspective as well. And that's exactly what I've done in the book. I don't include the formulas here because there's a limited amount of time to go through that, but I actually include the formulas for that exercise and that research in the book itself. So let's go on to the next page, and I'll show you what that looks like. So this is the graph of the function that I estimate using the VIX futures, the entire VIX futures history, all of the monthly contracts, daily data from, I believe it was 2004 through end of 2016. So I took all of that data in, which fortunately the CBOE provides for free. It's 155 different files of data. Brought the data back into a single spreadsheet, wrote the macros to do that, and then estimated a single function. It's a very simple nonlinear function that estimates the change in the VIX futures price as a function of the number of trade days remaining until expiration. So even if we go out only about a month, 20 trade days until expiration, the VIX futures, that is 1 month forward at that point, will only change by roughly half of the change in the VIX. So it really decays very, very rapidly, and again, that's a function of mean reversion. So the purpose of this exercise is that we needed to build a model to, one, forecast VIX futures prices. So that's included in the book, and that's the same relationship that I'm depicting here. The nonlinear relationship only uses a few parameters, and it's estimated using the entire history of VIX monthly futures data. The next step is, once we have this model, then we can simulate a black swan event. So in other words, if I expect the VIX index to increase by 20 points, or 30 points, or 40 points, or 50 points, I can actually calculate how much the 1-month VIX futures contract will increase. I can calculate how much the 2-month VIX futures contract will increase. But the key is that we need to be able to come up with this framework or analytical framework or curve estimation to be able to realistically forecast where VIX futures will trade at that point in time. So once we're able to simulate the black swan events, we can determine the at-the-money VIX call strikes. And if we can determine the at-the-money VIX call strikes, we can use that information to select the VIX call hedge strikes. In other words, we need to figure out which specific VIX call options we're going to consider as candidates for the hedge. And to do that, we need to know which ones are going to end up in the money and which ones are going to end up out of the money for the specific scenario that we're thinking about. And then finally, once we're able to calculate the at-the-money call strikes, we can then calculate the actual hedge profits for each one of the candidates that we are considering. So it sounds like an extremely complicated process, and it actually is a complicated process, but the calculations are actually done by the spreadsheet. Before I move to the spreadsheet itself, I want to go back one page just for a brief example to make sure that I've explained one issue that's important. Let's go back and assume that the 10/17/2008 scenario is actually our black swan event. Whether it's applicable or not, it really doesn't matter. But from an illustration perspective, let's assume that's representative of our black swan event. And we're sitting here today at 11/21/2013, and we expect the VIX index to go up. And let's assume that we're right. We assume the VIX index is going to go up to about 67% or 67 points on the VIX. So we assume that the VIX is going to go up by that much. And if we just say, well, let's just pick a strike level of 50. So if we pick a strike level of 50, then by definition, everything has got to be in the money at that point. But that's actually where the assumption falls down. The VIX itself is obviously going to be significantly above the 50 level. The 1-month VIX contract will also be significantly above the 50. We only have to go out 2 months to find out that if we were to buy a 2-month option, the hedge against a catastrophic loss on our option income strategy. And we actually expected that VIX level to be up in the 67 to 70 range. And it actually only made it up to 47. And we chose a strike on our options, VIX call options, of 50 across the board. All of these options are going to end up being out of the money. Sure, they'll still increase in value. There's no question about that. But essentially, we would not own enough of those options to hedge our portfolio. So the key is we need to figure out where the VIX futures are going to trade in a specific hedge scenario. And then from that, we can figure out how many contracts to buy, which strikes to buy, and then which one is the cheapest possible strike that we can use to hedge our position. Okay, so again, just to review, the hedge objective, we're going to look at all the candidates. We're going to calculate the number of VIX calls or the number of SPX puts. We're going to then identify the lowest cost the candidate with the lowest cost per trading day. And this is basically a 6-step process, which again is all done by the spreadsheet. But the first is, and I'll go through this on the spreadsheet itself, we're going to determine the hedge objective, how much money we need the hedge to make. We're going to define the risk event, which is the price change in the SPX or the increase in the VIX. We're going to enter current market data, so pricing data, strikes, risk-free interest rate, the market value, and so forth that we're trying to hedge, the number of days we would own the position, etc. We're going to then let the spreadsheet solve for the future option values for our specific catastrophic risk event scenario. We're going to calculate the hedge solution, meaning the number of contracts we need to buy, and then finally we can evaluate the hedge solution using scenario analysis. Once again, I recognize that it sounds complicated, but it's much easier to understand with the actual spreadsheet. Okay, I've got screenshots at this point in the presentation, but I think it would be much better if I can actually go over to the spreadsheet itself because it's a lot more interactive. So let's try that, and assuming that it's visible for all of you, and again, I would encourage you to use the full screen option here on your presentation just to be able to read this as much as possible. All right, so let's go through the 6-step process in the spreadsheet. So the 6-step process, number 1 is we need to define the hedge objective. That's done in these 2 cells here. So the hedge objective, we need to enter the amount of the hedge. So the amount of the hedge is we want to make 80% on a position of $106,000. So where does that come from? $106,000 is the Reg T requirement for the iron condor that I showed you before. We're willing to accept a 20% loss, which means that I need to hedge 80% of my position. Said differently, I need to make an 80% return, or the equivalent of an 80% return on $106,000, or I need the hedge to generate roughly $85,000 in profits. So that's it. That's the hedge objective. Next step is, what is the scenario itself? What is the black swan scenario? So in this case, I'm using a black swan scenario that says the VIX itself, the VIX index, not the VIX futures, the VIX index is going to increase by 45 points. That's really it. That's all there is to it. There's a lot more that goes into that calculation. You can study the historical incidents. You can go back and look at 1987, which I did in the book. So it's very helpful to understand how the VIX has traded in the past. But to a certain extent, we're actually anticipating something that may, in fact, have never have happened. So, for example, North Korea decides to lob a nuclear weapon over at the United States. They manage to hit San Diego out of luck. And, in effect, the portfolio could be down dramatically. The SPX could be down 20%, 30%. The VIX could go up to 50, 60, 70. So, in effect, we are forecasting events that have not happened. But that's the reason that this is, in fact, an interactive spreadsheet. So if you don't want to use 45%, you can use 60%. It really doesn't make any difference. I'm going to stick with 45 since that's what I did in the book. So that'll keep the calculations the same. All right. So step 1, define the hedge objective. Step 2, define the catastrophic risk hedge, or the catastrophic risk event, which is in this case the VIX increasing by 45 points. Step 3 is fairly simple. Enter market data. So the risk-free rate is necessary for option calculations. I've just entered 1%. The analysis date is 2/27/17. This is based on actual market data from 2/27. The spreadsheet actually provides or calculates the series of weekly and monthly options and weekly and monthly futures expirations for the VIX as well. So it calculates, I believe, 4 weeklies, and then the rest are monthlies. For each one of those futures contracts, we need to enter the mid-market price. So the top level up here, 1188, is the actual VIX index itself. The next level, 11.925, is the mid-price of the VIX futures contract that expires on 3/1/2017. Then the next VIX futures price, and so forth. Again, the reason that we're entering the VIX futures prices is because we need to use the VIX futures prices to price the options. In addition, we need to enter information about how long we anticipate owning the trade. So in this case, the maximum time period that we would own the trade is 33 days, 33 trading days. And that is a function of your specific strategy. It is when you expect to exit the trade and be out of the trade for certain. So in this case, I've assumed that that's 33 trading days into the future. Now the spreadsheet, you don't need to focus on this number, but the spreadsheet actually only analyzes one date at a time. What that means is it actually assumes that the black swan event is going to occur exactly 15 trade days in the future. And you ask yourself, well, that's ridiculous. We don't, if we knew the VIX, or we knew the event was going to happen exactly 15 days in the future, we wouldn't need to hedge. And that's absolutely correct. But what the spreadsheet is going to do is it's going to iterate through every single one of the possibilities. So it's going to iterate through the calculations of 0 trade days, then 1 trade day, then 2 trade days, then up to 15 trade days, and all the way up to 33 trade days in the future. And the reason that's important is because the results are dramatically different, and we'll go through that in a second. And then finally, the last pieces of information we need to choose a selection of call strikes, candidates that we're going to look at. And then for each one of those, we need to enter the ask price, the actual ask price where we can buy that security, not necessarily the quoted ask price in the marketplace. And that information is going to be used to calculate the option values themselves. And then finally, we enter a bid-ask spread of 10 cents and an actual commission of 70 cents per contract. Again, those are variables. Anything in a blue cell you can change. So it was brought up in the chat panel before, how do we actually choose the strikes? So for example, let's look at the first strike example. So the first candidate expires on 3/1/2017 and actually 2 trade days. So what you'll know if you've traded the VIX options is that ridiculously, there are 5-cent increments for the option contracts. So as a result, in this particular case, we obviously, since we're buying call options, we obviously prefer the call option that has the lowest strike price for a nickel. You're going to see a boatload of options that you could actually buy for a nickel. But why do I want to buy a call option on the VIX with a strike of 20 for a nickel when I can buy one with a strike of 14 for a nickel? You're going to see the same thing even as you move out to 7 trade days and even 12 trade days in this case. You're going to see a number of candidates that all have the same listed bid-ask price. And typically, that might be 0 to a nickel. This might be 5 cents to 10 cents. There's no way to get a mid-price execution on a 5 cent to 10 cent level. You can try to get filled at 5 if you want, but the fact is that you're going to see a number of options that are offered, all with different strikes, that are all listed for 10 cents. Now, once we actually go out farther along the term structure, you're going to see a more of a disparity in prices, so $1.35, $1.45, and so forth. So the key here is that we want to make sure that each one of these strike prices, which I've actually capped at 25, is above the terminal price for the VIX. So what we see here is that using the VIX Futures Model that I talked about on the preceding page, it actually forecasts the change in the VIX for that 45-point move. And obviously the change in the VIX is very, very different for every candidate. And as a result, the terminal VIX price, the terminal VIX Futures price, which in this case is 15 days in the future, is roughly 57 for the VIX index, drops to 55, drops to 46, 43, and so forth. And as a result, it's dropping uniformly as we move out along the term structure of volatilities. And as a result of that, we want to make sure that that 25-point strike exceeds the ending forecasted VIX value for our specific 45-point move. So that's the technique that I use to select strikes. It's really more of an art than a science, but the fact is just to make sure that we have a better valuation on our ultimate security, I would like it actually to finish up in the money. With respect to the short strikes, it's very simple. You just buy the lowest strike for the specific ask price for that candidate. In other words, for that expiration date. Okay, so at this point, we have specified the objective that we need to earn roughly $85,000 on the hedge. We specified what's going to happen to the VIX index itself. We forecasted changes in the VIX. And I'm going to point out one thing at the risk of sabotaging my own presentation, but it's important that you see this because if you're looking at the data carefully, you may have this question. So the question is, the future price of the VIX here for the 3/15/2017 is 43. So it's 56, 55, 46, 43, and then 53. And you look at that and you say, that's ridiculous. That cannot possibly happen, and then it drops to 37. Okay, the reason is, and actually I would agree with you, that looks ridiculous at the surface. But this spreadsheet looks at what's going to happen exactly 15 days into the future. I haven't aggregated the results yet. So exactly 15 days in the future, that option is going to have 2 trade days remaining until expiration, meaning it's going to be at the exact front end of the term structure of volatilities. So that 53 that you're seeing there is a very realistic number and is actually where that VIX futures contract will trade. Even though it has 17 trade days to expiration today, 15 days from now, it's only going to have 2 trade days remaining till expiration. So the model is relatively sophisticated in that for every day that you do the analysis, it's actually going to figure out exactly what the remaining time to maturity is for each one of those options specified in trade days. So it accounts for that in the calculations. Okay, so we've completed steps 1, 2, and 3. Got a hedge objective. We've defined the catastrophic risk event. We've got market data. Now I'm concerned with market valuation. If I have market data, then I can now calculate implied volatility. So let's do that. The rest of this is done in the spreadsheet itself. So step 1 in the analysis, clear the implied volatility. So those were left over from a previous analysis. Now I'm going to calculate the implied volatilities. It populates the rest of the spreadsheet. So essentially what it did was it took the prices and the expiration dates for those options. It calculated the initial implied volatility. It's then going to look at two scenarios. Scenario one is, what happens if there's no change in the VIX itself? Basically, those options are going to expire worthless. Or it's also going to look at what happens if the VIX goes up by 45 points, in this case, in exactly 15 days. That's going to give me an ending implied volatility. Then it's going to calculate from the implied volatilities what is the ending call price in the no change environment. What's the ending call price in the black swan event? What's the call profit in the black swan event, assuming that it occurs exactly in 15 days, which I recognize, again, is not useful. And then we still don't know the average profit yet. So at this level, we have now forecasted future levels for the call option prices in the two scenarios, so the unchanged scenario and then also in the black swan event scenario of the VIX up 45 points. All right, so we don't technically know what the solution is, although you're actually looking at a solution here. So the next step would be to populate sample hedge values. And all this is going to do, if I get control back of the spreadsheet, is it's going to fill in a range of values of 10 contracts. So the 10 contracts is obviously not correct, but it needs to start with some number of contracts to do the calculation. From that, I'm now interested in the average VIX change. I'm no longer interested in, and never really was interested in, what happens exactly 15 trade days in the future. I really want to know what's going to happen if I held this hedge and replicated it over the entire 33 days. So I'm going to calculate the average change using the macro, and that's going to populate these fields. So that populated those fields there, which says on average we're earning anywhere from $5,000 to $39,000 on the hedge. But the reason is because the hedge calculation just assumes a random 10 contracts. So now that we have these average profit values, I can go back and calculate the actual number of hedge contracts that I need using the macro, and then finally recalculate the average. And what you see here is now the average values are basically all $85,000, every single one of them, because it solved for the number of contracts that was required to generate an average return or average profit on the hedge of 85 grand. Now, what we're really interested in here is what is the lowest cost contract, assuming our assumptions are obviously correct, but what is the lowest cost contract that we can buy out of all of our candidates? So the lowest cost contract is shown, or the actual cost per trade day, is shown in the far right-hand column over here, which says total cost per trade day. And you can see there that the total cost in this case is $22 per trade day. So $22 per trade day, let me just do that calculation quickly, multiplied by 33 is $726 on $107,000 roughly, or about 67 basis points, 0.6%. So that is not an insignificant cost to hedging that position. But at the same time, it's a hell of a lot better than $109 per trade day or $209 per trade day. So the benefit of the spreadsheet is that it actually allows us to identify the cheapest cost solution for our specific hedge scenario. Get rid of that. Okay, a question, having position in RUT options, shall I use RVX call options instead, or is it not possible due to the formula derived for VIX options? I don't even know if RVX options actually exist. If they do exist, I'm guessing that the liquidity would not be actually sufficient for this. So at least with respect to this analysis using VIX calls, perhaps Tom or someone else can jump in there whether RVX call options exist. I do not know if they do or not. I know they've actually implemented RVX futures contracts, which are not very liquid, but I do not know if the RVX calls exist or not. But I would suspect there's a liquidity issue there. With respect to the next page that we're going to talk about, using the underlying equities, obviously you could use RUT put options directly, but I do not believe you could use RVX calls. How is the second option best if there are only 7 days that expire and perfect? Okay, so again, the spreadsheet's a little tricky the way it works, but let's go back to that example. So the spreadsheet shows that the lowest cost option was the option that expires in 7 trade days. So, and it says that the total cost is $22, but it's actually the total cost per trade day. So what that means is we can directly compare all of these costs, and the spreadsheet assumes that when that option expires on 3/8/2017, it assumes you're going to actually go out and go back and buy another option with 7 trade days remaining until expiration, and you're going to buy it for a nickel. Obviously, the prices could be different at that point. The environment could be different, but we can't. There's nothing we can do about that today. In effect, what you would do in practice is when your options expired on 3/8/2017, you would reopen the spreadsheet, re-input a set of futures prices, re-input a set of call strikes and ask prices, and then solve for the new cheapest cost hedging solution at the time. It might be the first week option. It could be the third week option. It could be any of the options. But the point is, as the market evolves, you would reuse the spreadsheet again using real-time market prices to redo the analysis. All right, so that is an example. We've actually gone through 5 steps. We've now gone the hedge. Let me delete this information off the screen. We've gone through the hedge objective. We've calculated the risk event, input the market data, valued the options, and actually calculated the hedge solution. The last step that I'll cover on this page is the scenario analysis. So the scenario analysis is twofold. One, we can look at the solutions over trade days 1 through 33, but this time we can actually look at the minimum, maximum, and the profit range. So for the candidate that we looked at before, the lowest cost solution candidate of $22 per trade day, we see that the min profit was $72,000, max profit was $103,000. So there's a dramatic range of $30,000 for that position. So if we were to actually use that to hedge, depending on the exact day the black swan event occurred, we might only generate a profit of $72,000. At the same time, there could be a windfall, and that we'd actually generate a profit of $103,000. The other way that we can use this spreadsheet as a form of scenario analysis is instead of entering 45, you might ask yourself, what happens if the VIX only goes up by 30? And if we do that, we don't need to change the hedge amount first. We can actually just rerun the averages. And what you see there is that the averages dropped significantly down to 55,000, 51,000, and so forth. And again, we can look at our candidate and say that it earned 51,000, better than some. And again, that's over the average of the trade date 0 through 33. But it definitely fell short. Conversely, if the VIX were to go up by 60 and we recalculate the averages again, we can see that now the profits are in the 100,000, 15, 119, 121, 125, and so forth. So again, the spreadsheet is designed as an interactive tool that can be used to figure out what is the cheapest possible solution at any given point in time, but it also can be used as an interactive tool to hypothetically look at a range of different scenarios. All right, so I recognize that we're running out of time at this point. I just want to go over briefly to the SPX spreadsheet. I've already done the calculations here, but the sequence is actually the same. You go through the same six steps. You clear the IVs, calculate the IVs, populate the hedge values, calculate the averages, calculate the final solution, and then recalculate the averages. And then from that, what I'll show you briefly, and the only thing that I'm interested in here, is the cost. For the lowest cost solution here is an option that expires in 4 trade days, offered for 10 cents with a strike price of $21.35. That can be purchased for $9.6 per trade day. So $9.6 per trade day on a position of about $106,000 drops our hedge costs down to approximately 30 basis points, or 0.3%. Still not insignificant, but it's a heck of a lot better than paying 2 times that amount, or 4 times that amount, or 6 times that amount if you choose the wrong candidate. Okay, so let's go back to the presentation briefly. We've covered almost all of the material at this point. Let me just sum up. So, in summary, which underlying securities we can use? Anything that has a futures contract or an options contract, we can actually use to do the futures hedging and the options hedging. As I mentioned before, the RVX calls probably do not exist. If they have, I haven't traded them. So that's an issue with respect to the VIX. But there's no reason that you can't use the options on the underlyings themselves. Which are the applicable strategies? Anything with negative gamma and or anything with negative vega. By the way, this actually includes ETFs. I know a number of people, including myself, have strategies that trade some of the VIX volatility ETFs or ETNs. However, if you're short volatility in those ETNs, the value of that position could easily go to zero in the event of a black swan event. So as a result, we not only need to hedge our option income strategies, but we also need to hedge any type of short volatility strategy as well. When to hedge? I recommend putting those hedges on immediately upon entering the option income strategy. Options or futures? Both. I believe in a belt and suspenders approach in this case. Futures cannot fully eliminate the risk of either a black swan event or even an overnight decline in the market that's significant, mainly because the futures may or may not be open. Options can be used to hedge black swan events, but we need some kind of underlying framework for that purpose. Do we use VIX call options or the underlying put options? Use the cheapest of both. If you think your scenarios are equally likely for an increase in the VIX index and for the decline in the SPX price, and they're comparably valued, meaning the cost of those are similar, you could actually diversify your hedge by buying some VIX call options and some VIX put options. But again, we have to look at the cost of each one of those hedges when we make that decision. And then finally, what is the precision of the spreadsheet values? And I'm not going to sugarcoat it here. We're talking about changes in the VIX of 45 points potentially overnight or more. We're talking about declines in the SPX 15, 20, 25%. The spreadsheet uses values that are theoretically sound, that are based on the consistent price moves that we've seen historically in the VIX. We're trying to come up with reasonable values, but we're certainly not going to be down to pennies when we're talking about the precision of the spreadsheet value. All right, the last thing that I want to mention briefly, and I mentioned at the start of the presentation, is that there is one subscription that I offer through Trader Edge. It is for the option income strategy universal filter. There is a book that I put out before this. I only offer a single subscription. It was written up in the option income strategy trade filters book extensively. There's also some additional information on the website for it as well. But essentially all it does is it uses an algorithm to calculate an OIS score, if you will, based on price and implied volatility, both current and historical data. And that score is then used. I use the Quanti Carlo backtesting methodology with over 15,000 iron condor trades, the RUT, SPX, and the NDX, and I backtested that approach. And as I mentioned before, with no filter at all, you're seeing the results there on the screen. But what happened is the profit factor increases proportionally as the OIS score goes up. Similarly, as does the percentage of winning trades, and as does the average return on margin as well on a per trade basis. And in fact, the correlation between the percentage of winning trades and the OIS score itself is almost perfectly positively correlated. And the average return on margin also is almost perfectly positively correlated as well. So at Tom's suggestion, I'm offering a 10% discount. I set the expiration date to May 14, 2017. That gives anyone who's interested to pick up a copy of the article or go back to the website and research that information in more detail. The subscription price is normally $59 a month, and the 10% discount would make it $53 a month. If you are interested in looking at that further or potentially capitalizing on it in the future, I do not advertise this discount. I've never used a discount before. So this address is the only way that you'd be able to obtain it, which again I'll leave up for the next month, roughly until May 14, 2017. It's https://traderedge.net/discount-offer, and if you're interested, you'll be able to take advantage of it on that screen.
Very good, Brian. Excellent presentation. Had a lot of good participation in the chat, which is always nice to see. And we hope to have you back in the future. So thanks again for coming. Do you have any last comments before we wrap it up?
No, that's it. The only other information is my contact information is at the bottom of the page. So if you have any questions after reviewing the material or after reading any of the books, I try to respond to emails as promptly as possible. Obviously, I don't provide investment advice, but that's the best way to reach me is through bjohnson@traderedge.net, and I appreciate the opportunity and look forward to presenting again in the future.
Oh, great. We've already got a request for you to do a presentation about your risk-return ratios book. All right. Well, thanks again, Brian. Thanks, everyone. I'll get this posted as soon as possible, and we'll hope to have you back in the future.
Okay. Appreciate it, Tom. Thanks again.
Take care.
Yep. All right. Bye-bye.